Committee will come to order. Chairman Greenspan, we want to welcome you to your first appearance at our semi-annual monetary policy hearings. 13 years ago, this committee initiated legislation to require this regular reporting by the Federal Reserve. Those provisions were folded into the Humphrey-Hawkins Full Employment and Balanced Growth Act of 1978, under which we convened today's hearing. These reporting requirements are part of a long and at times frustrating effort on the part of the Congress to bring about coordination of Federal Reserve policy making with other economic policy making of the federal government, and to try to gain some understanding of which way the weather vane is pointing down on Constitution Avenue. The success of these efforts and the ability of the committee to carry out its mandate under the Humphrey-Hawkins Act depends on how seriously the Federal Reserve takes its responsibility for these semi-annual reports. The success depends on the willingness of the Federal Reserve to speak openly and frankly and to explain its policies in terms that have some meaning in the real world. Dr. Greenspan appears here today at a very critical time for the economy. We're still examining the real and imagined wounds of last October's market crash. There are growing storm clouds which are currently being described as slowdowns. Only time will tell whether slowdown is a euphemism for recession. In his economic report released last Friday, it appears the President is positioning himself to find a scapegoat should the economy falter. The President stated, "The prospects for growth in the immediate future have been diminished by last year's plunge in the stock market, as well as by the increase in interest rates and tightening of monetary policy during the year 1987. Clearly, the President is directing his comments at the Federal Reserve policy. Now, Dr. Greenspan, I hope you will indicate at the outset to what degree actions of the Fed have contributed to what the President describes as diminished prospects for growth. January and February are great months for economists. Like racetrack tout sheets, there's a projection and prediction for everything. We have the State of the Union address, the economic report of the President, the budget, the Federal Reserve's monetary report, and an unending supply of projections from the private sector. These monetary policy hearings should play an important role in trying to sift through these conflicting opinions. At a minimum, it's a chance to examine the economic data, formulas, and projections outlined by the President's economic advisors against the Federal Reserve's policy prescriptions. This is a particularly important exercise in light of the long era of fantasy budgets and economic projections that have not come close to any target. Rosy scenario has been this administration's favorite mistress. Slowly, there is a realization growing that Alice in Wonderland economic projections do not answer the massive problems of budget and trade deficits. Rosy scenarios fade quickly when we see the federal government increasing its debt by a whopping $500 million each and every day. It's unbelievable that net outlays for interest payments on the debt are nearly $150 billion annually, roughly equivalent to the combined outlays for Medicaid, Medicare, AFDC, food stamps, and related programs for the poor. These are outlays that go to banks, the more affluent in our society, and in many cases to foreign investors. Again, Dr. Greenspan, we do indeed welcome you. We look forward to your testimony. And I hope you'll be able to not only describe the policy, but to indicate where the policy will lead us in the coming months. We need an economic roadmap as the Federal Reserve has charted its course. Mr. Wiley.
Thank you, Mr. Chairman. I, too, want to welcome you, Chairman Greenspan, to this hearing on monetary policy this morning. Since your predecessor, Mr. Volcker, testified here before us last July 21st, our financial institutions, and particularly the stock and futures market, have been severely tested by events of last October. There were many, like myself, who were greatly concerned about the potential spillover effect on the rest of the economy. However, thanks in no small measure to the prompt action by the Federal Reserve and your reassuring promise of expanded liquidity, the equities markets were restored to more normal conditions and to more sustainable levels than those prevailing before last October. At the same time, the effect on the real economy appears so far to have been less damaging than had been feared. There are even those who argue that the economy, because of the shakeout and the expected moderate activity, will enjoy a more extended growth during the month ahead than would otherwise have been the case. Public policy must remain alert, however, to the possibility of a recession. Although in recent testimonies before the Joint Economic Committee, most economists ruled out a recession in 1988. We need to be alert for no other reason than we are now entering our 6th year of expansion, and the burden of personal and corporate debt remains very high. These and similar circumstances, I should think, limit the amount of monetary restraint that the Federal Reserve could apply in the event of stronger than anticipated business activity. Conversely, the desire to stabilize the dollar and avoid potential price pressures from the import sector somewhat limits the Fed's ability to stimulate the domestic economy by monetary and credit expansion should business activity prove disappointing. It seems to me, therefore, Mr. Chairman, that the Federal Reserve must walk a fine line between the dangers of renewed inflation and recession. In this endeavor, my colleagues and I wish you well. We look forward to your statement with anticipation. Thank you again for being with us this morning. Thank you, Mr. Chairman.
Mr. Mr. Neal.
Thank you, Mr. Chairman. Well, I'll be brief because I certainly want to hear from Dr. Greenspan, but I just want to say I know he has a tough job, he and his other governors this year. As Mr. Wiley has pointed out, too little money growth and recession, too much, and we run the risk of inflation. And it's a tough job, and I guess what I really want to point out is how important this job is. Again, that in fact Federal Reserve policy drives our economy, much more important than fiscal policy in terms of levels of employment in our country, levels of inflation, interest rates, and also to point out that I hope the public will look with great skepticism upon those politicians who run around the country saying that they're responsible for bringing down the rate of inflation and the high rates of interest that we had in the late 70s. The fact is that nothing that has been done on the fiscal side by either the administration or Congress has helped in this regard at all. In fact, it's been very counterproductive. And under the very able leadership of Paul Volcker, the Fed did successfully bring down a runaway rate of inflation that had been created earlier by other Federal Reserve boards. So I just want to point out this is very important, and you've got a tough job, Mr. Chairman, and we wish you well. We'll have some questions at the appropriate time. Thank you.
Well, with that, Chairman Greenspan, we are now prepared to hear from the Federal Reserve Board by way of your testimony, your report to the Congress. We'll place your entire submission in the record, and you may proceed.
Thank you very much, Mr. Chairman. Mr. Chairman, members of the committee, I appreciate this opportunity to appear before you to discuss the conduct of monetary policy and the economic and financial situation. You have received the more formal report of the Board of Governors detailing the economic and financial situation and reviewing our policy actions in 1987 and presenting our approach to monetary policy this year. The setting for monetary policy for the year 1988 and beyond is more than normally complex. While the economy itself is well into the 6th year of expansion, the forward momentum of that expansion has been brought into question, and we continue to run sizable external deficits with associated dependencies on foreign savings. At the same time, inflation rates, while below those of earlier in the decade, are still high in a long-term perspective. Moreover, uncertainties persist about key indicators of policy, the monetary aggregates, and their relation to the performance of the economy. Our approach to monetary policy in 1988 will require a delicate balancing of considerations which must take into account of the difficult multi-year challenge we face in seeking to wind down our external deficits in a manner that is consistent with the maintenance of sustainable growth in the United States and the world economy in 1988 and beyond. Towards this end, the Federal Open Market Committee 2 weeks ago set somewhat lower target ranges for 1988, consistent with a moderate pace of monetary expansion this year. The ranges for M2 and M3 are 4 to 8%. For debt, we have set a monitoring range of 7 to 11%. The annual ranges are wider than in the past, recognizing that the linkage between money and credit growth and economic performance has become noticeably looser in recent years. Before discussing our monetary policy plans for 1988 in detail, I would like to review with you the developments of the past year. The year 1987 was a time of economic transition, and like many periods of change, it had its difficult moments. Nevertheless, clear progress was made in achieving a healthier, more balanced economy. For the year as a whole, output and employment expanded strongly. As measured by the gross national product, production increased nearly 4% from the fourth quarter of 1986 to the fourth quarter of 1987, according to the Department of Commerce's preliminary estimates. Almost 3 million persons were added to payrolls over this period, and the civilian unemployment rate dropped to about 5.75%, the lowest level in this decade. We achieved this growth with a better relationship between domestic spending and domestic production. Growth of private domestic final purchases has slowed progressively from 7.75% in 1983 as the economy emerged from recession to about 1% last year. Meanwhile, real exports of goods and services rose more than 15% over the 4 quarters of 1987, as our international competitiveness was enhanced by the success of business and labor in increasing productivity and restraining cost pressures. In addition, the lower level of the dollar on foreign exchange markets, because much of it was not passed through into wage and other costs domestically, also helped our firms price more competitively in foreign markets and to compete with imports in the United States. The trade sector improvement accounted for more than a quarter of the overall gain in GNP. One aspect of the improved trade situation was better balance of our economy internally, with previously lagging sectors showing particular strength. The manufacturing sector revived in 1987. Industrial production and manufacturing surged by 5.5% between December 1986 and December 1987, and capacity utilization rose to its highest level in 7 years. For example, output of steel rose especially strongly, which was the main factor in bringing capacity utilization in this industry from about 65% at the end of 1986 to above 90% at the end of 1987. And other areas of our economy that had been notably depressed earlier in the 1980s, such as farming, mining, and oil extraction, showed some signs of improvement. The robust growth of the economy, in combination with the budgetary actions of the Congress and the President and a one-time boost from tax reform, brought about a major reduction in the federal budget deficit last year. To be sure, the flow of federal red ink still was heavy, but last December's agreement was at least a first step in the needed actions for the future. On the negative side, inflation increased in 1987. This development was not altogether surprising given the bounce back in energy prices earlier in the year and the effects on import prices of the decline in the dollar. Although wage gains have remained subdued, we clearly need sustained effort to bring about a more stable price level. As you may recall, the Federal Reserve sets ranges for monetary growth in 1987 that were 0.5 percentage point lower than in 1986. We also noted that we would be conducting monetary policy with an eye towards a variety of economic indicators, including the strength of the economy, pressures on prices, and developments in international markets, as well as money growth relative to the ranges. Although the aggregates from very early in the year tended to run low relative to the ranges, the challenge as we perceived it through much of 1987 was less to buoy money growth than to prevent one-time price increases related to developments in energy and foreign exchange markets from becoming rooted in a renewed inflation process. Concerns about potential inflationary pressures were clearly manifested in financial markets as well. During the spring and again in late summer, inflation worries pushed up commodity prices and long-term interest rates, and heavy downward pressure on the dollar developed in light of growing pessimism about the prospects for significant improvement in U.S. external balances. Concerns about the financing of our external deficit, in turn, apparently added to pressures on interest rates during these episodes. In view of the inflationary potential, the Federal Reserve increased somewhat restraint on reserves in both episodes, and in September raised the discount rate from 5.5% to 6%. The balance of risks shifted following the stock market collapse of October the 19th. The Federal Reserve immediately modified its approach to monetary policy in light of the turbulent financial market conditions. During the crisis, the system temporarily altered its focus somewhat from reserve positions to more direct measures of money market pressures, and took a number of steps to ensure adequate liquidity in the financial system. Moreover, we encouraged some decline in short-term interest rates as a precautionary step in light of the possibility that the contraction in financial wealth and the deterioration in consumer and business confidence might lead to a significant drop-off in spending. These actions helped to restore a degree of confidence in financial markets. As this occurred, the Federal Reserve returned some way toward our earlier focus on reserve positions in the day-to-day implementation of policy. But I think it is fair to say that the markets still are exhibiting a certain edginess, and we can't be sure yet that the normal market functioning has been fully restored following the events of October. In addition, the effects of the stock market events on the economy may not be fully evident. Indeed, indications of some softening in the economy as the year began, against the background of a more stable dollar in foreign exchange markets, led us to take a further small easing step a few weeks ago. In the context of a monetary policy that, for much of the year, needed to counter inflationary pressures, and in light of the very rapid money growth in 1986 and marked variations in velocity in recent years, modest expansion of the monetary aggregates in 1987 was viewed as acceptable and appropriate. As market interest rates rose, interest rates on deposits became less competitive. This encouraged the shifting away from monetary assets, and growth of all of the monetary aggregates slowed sharply. In addition, some special factors may also have dampened money growth last year, such as the effects of the new tax law, changes in bank funding sources, and evolving business practices with respect to cash management and compensating balances. M2 and M3 grew 4 to 5.5%, rather 4 and 5.5% over the 4 quarters of last year, respectively, leaving them below and just at the lower ends of their annual ranges. M1 increased 6%. Debt growth slowed to the midpoint of its monitoring range. The progress in reducing the federal budget deficit helped reduce borrowing, and debt issuance by the private sector dropped off as well. Debt growth could scarcely be characterized as slow. At 9.5%, it continued the pattern of increases relative to GNP. In formulating its monetary policy plans for 1988, the FOMC sought to further a number of complementary objectives. The committee continued to focus on maintaining the economic expansion and on progress toward price stability, which was seen as a necessary condition for long-term sustained economic growth. It also recognized that satisfactory performance of the economy depended on moving over time toward better balance in our external accounts. For 1988, committee members generally were optimistic that policy could be geared to meeting these goals. Most members foresee continued economic growth next year with no significant pickup in inflation, although at current levels of resource utilization and with rising prices of imports likely from recent dollar declines, vigilance against signs of a reemergence of greater inflationary pressures will continue to be needed. The central tendency of FOMC members and other Reserve Bank presidents' forecasts is for growth in real GNP of around 2 to 2.5% from the fourth quarter of 1987 to the fourth quarter of 1988. Slower than in 1987, but likely close to what is a sustainable pace over the longer haul. The unemployment rate may not drop further, but employment gains could again be substantial and better distributed across industries and geographical regions. Much of the impetus to growth is expected to come from a rapid pace of expansion of net exports of goods and services, which would promote the process of adjustment to better balance internally and externally. This should involve slow growth in domestic demand, probably encompassing damped gains in consumption and a much reduced pace of inventory building from the pace near year-end. Recent patterns of wage negotiations and settlements do not seem to indicate any imminent break from the restrained behavior of the mid-1980s. Although capacity utilization has risen in our manufacturing sector, bottlenecks are not as yet a problem and are not expected to become one if growth follows the subdued path of the committee's outlook for real GNP. Even so, we cannot be complacent about the potential for higher inflation. By the time an acceleration of costs and price pressures were to become evident, the inflation process would already be well entrenched. With its objectives in mind, as I noted earlier, the FOMC established ranges for M2 and M3 of 4 to 8% over the 4 quarters of 1988, with debt of domestic non-financial sectors expected to increase between 7 and 11%. The growth ranges for money represent a decrease from those for 1987 by 1 percentage point in terms of the midpoints. This reduction is viewed as another step in the longer-term process of reducing targeted money growth to rates more in line with reasonable price stability. Moreover, the lower end of the ranges allows for the possibility of little pickup in money growth, especially M2, from 1987 under certain circumstances. If, for example, inflation expectations were to strengthen, market interest rates would tend to rise, and relatively slow money growth could again be an appropriate policy stance. The FOMC does not anticipate that circumstances will call for such slow money growth. In fact, it expects some acceleration of monetary expansion in 1988, perhaps to around the middle of the ranges. But changing circumstances could easily require a considerably different outcome. In recognition of the unusual degree of uncertainty in the economic outlook and the large movements of money relative to income in recent years, we have widened the specified ranges for monetary growth from the more traditional 3 percentage points to 4 points. This change was advisable partly because the linkage of money to spending and income appears to have become looser in the 1980s. As you know, most historical experience has suggested a fairly close relationship between spending and the quantity of money, and over a longer run between money and prices. These relationships establish the basis for adopting specific targets for growth of money in order to attain the ultimate goals of macroeconomic policy. But these relationships appear to have changed considerably in the 1980s, partly reflecting the effects of deregulation, innovation, and changing technology. The spectrum of stores of value is extremely broad, extending from real capital like plant and equipment and houses on the one hand, through stocks, bonds, and time deposits to perfectly liquid currency and checking accounts on the other hand. Both households and businesses are continually adjusting their balance sheets and the allocation of their income flows between accumulation of financial assets of different sorts and acquisition of goods and services. Transaction balances are on the edge of the exchange of financial claims for goods and services. Regulation and established practices previously acted to enforce a marked separation between transactions money balances and all other balances and supported a fairly close relationship between spending and the quantity of transactions money as measured by M1, which allowed it to serve as a monetary policy guide. Businesses and households maintained transactions balances and demand deposits in fairly close relation to their spending requirements and relied on other forms of deposits to serve as longer-run stores of value. But now deregulation and improved information and communications technologies have blurred distinctions between transactions balances and other assets. Businesses can move unneeded transaction balances at each day's close into Eurodollars, repurchase agreements, commercial paper, or CDs at little cost, with the choice among these instruments often depending on yield differentials of only a few basis points. In addition, firms now can maintain balances in hybrid instruments like MMDAs and money funds and retrieve them nearly as easily as they can from a regular checking account. Remaining business demand deposits serve importantly as balances that compensate banks for services, and these arrangements too are evolving over time. For households, now accounts, interest-earning, fully checkable deposits are important savings as well as transactions vehicles and have contributed greatly to the decreasing usefulness of M1 as a monetary target. This process of innovation and deregulation has affected the behavior of the monetary aggregates in a number of ways, only some of which we fully understand. To some extent, it seems simply to have introduced more noise in the money-spending relationship. In addition, though it appears that one important consequence has been to increase the sensitivity of the demand for monetary assets to changes in market interest rates, at least over the short run. While deregulation has allowed institutions to vary the rates on deposits, in practice, returns on many categories of deposits are adjusted sluggishly in response to changes in market rates, giving rise to relatively large swings in incentives to hold these instruments. Now accounts may be the most prominent example of this. Because these accounts are close substitutes for other liquid instruments as a store for savings, holders of now accounts are highly sensitive to changes in interest rates on these alternate investments. They place a larger volume of funds into now accounts when rates on other deposits at banks and thrifts are relatively low and deposit smaller amounts of actually drawdown checking account balances when investment opportunities are more attractive elsewhere. Widespread compensating balance arrangements for businesses imply a strong interest responsiveness of demand deposits as well. Changes in market interest rates alter the earnings value of these deposits to banks, with resulting adjustments to the balances required to compensate the bank for a given package of services. M2 is a broader collection of the public's liquid assets and as a consequence internalizes some of the shifts that have plagued M1. But M2 is still somewhat limited in its coverage of financial wealth held in liquid forms, and shifts between M2 and other financial assets may not by themselves imply changes in spending tendencies. Such shifts have been unresponsive to movements in the rates on alternative investments relative to returns on M2 balances. This sensitivity, though considerably less than for M1, also seems to have increased since the late 1970s, perhaps as improved information and communications technologies have facilitated transfers of funds between M2 assets and those outside this aggregate. Over the longer run, once rates on instruments in M2 adjust to changes in market rates, this aggregate tends to grow in line with income as it has on average over the post-war period. M3 adds to M2 a number of managed liabilities that banks and thrifts use to supplement their retail deposits in order to fund credit expansion. Unlike M1 and M2, it is highly responsive to the decisions of institutions as to how fast to expand their balance sheets and what particular sources of funds to rely on. Small changes in interest rate relationships can have very substantial impacts on the funding decisions of these institutions and consequently on M3 without major implications for income and prices. M3 then is determined largely by the decisions of depository institutions on how many liabilities and what type they wish to supply to the markets. The managed liabilities in M3 are very close substitutes for other money market instruments in the public's portfolio. M1 and M2, by contrast, can be thought of as depending more directly on the public's desire to hold the assets included in these aggregates, given the returns on various alternative investments, as well as levels of wealth and income. Banks and thrifts, of course, do vary the offering rates on their M2 type deposits in order to affect the quantity of these deposits they receive. But these adjustments tend to lag market rates, and while the M2 holding public is sensitive to alternate yields, it is not nearly as sensitive as the money market investors holding managed liabilities. In these circumstances, the connection between M1 and M2 and the economy rests importantly on the effect of interest rates on the demand for these aggregates. For example, a more expansive monetary policy, increasing reserve availability or lowering the discount rate, boosts demand for these aggregates as interest rates decline and, with a lag, stimulates economic activity. Given uncertainties about how financial market pressures in fact may need to vary in response to changing conditions in the economy, it is difficult in advance to decide on the appropriate growth of an aggregate that is sensitive to movements in interest rates. Such growth could range over a fairly wide spectrum and still be consistent with satisfactory performance of the economy. In these circumstances, the committee decided that a modest widening of the ranges for M2 and M3 would better encompass appropriate monetary growth while still providing a guide to policy. This analysis also underlies a decision, again, not to establish a target range for M1. We have monitored the behavior of M1 and conducted careful analysis of its properties. While some of M1's erratic behavior remains unexplained, we now believe that most of its unusual movements relative to income in recent years is attributable to a heightened and now quite large interest elasticity. In view of this behavior, our calculations suggest that something like a 7 percentage point range would be needed for M1 in order to encompass the same range of uncertainties as is captured by our 4 percentage point range for M2. Such a wide range would be of little use in the conduct of monetary policy and in communicating the stance of monetary policy to the public. One should not conclude from this that the Federal Reserve is giving up on monetary targeting. We are not. The linkages between money on the one hand and prices and spending on the other may have loosened, but that is mainly a problem over the short run. The chain still exists. We are continuing to study these relationships carefully. At some point, the shorter run link could well become tighter again. In any event, economic theory as well as historical evidence are quite persuasive that over the long run, money, income, and prices tend to move together. The FOMC expects to achieve its aggregate ranges for 1988. We will, however, need to continue to interpret the incoming information on these measures in light of other data on the performance of the economy and prices and other indicators of the impact of monetary policy. We face formidable challenges over 1988 and beyond in meeting national economic goals of sustaining growth and progress toward price stability. Some of these relate to the short-run outlook of the economy as the possible effects of the stock market decline and the buildup of inventories late last year worked through in 1988. But our more fundamental task remains managing the process of restoring internal and external balance that is now underway. This is a challenge that cannot be negotiated by the Federal Reserve alone. It will require complementary and consistent actions by our colleagues in the Congress and the administration, as well as our major trading partners. For the United States, the most direct and beneficial approach would be to address the problem at its major source, the federal budget deficit. Reducing the deficit further would give us the opportunity to add to domestic savings and reduce dependence on foreign capital while still encouraging much-needed investment spending. Because the United States is now operating at relatively high rates of resource utilization, domestic demand must be restrained if our international sector is to expand without more inflation. In the absence of fiscal restraint, greater pressure would be felt in financial markets with negative consequences for investment and other private spending. While recognizing the need to supply the liquidity required to keep our economy expanding, monetary policy cannot lose sight of the need to keep inflation pressures under control. We cannot permit the price level adjustments associated with restoring external balance to feed through into a renewed inflation process. Escalating prices and costs would reverse the hard-won gains in our international competitive position, leading inevitably to more difficult and wrenching adjustments down the road. Progress toward price stability is the foundation on which the longest peacetime expansion in our nation's history has been built, and continued efforts along this line will be the framework for future economic advances. Our gains in international competitiveness have reflected a number of forces, but we should not underestimate the effects of the efforts of business and labor over recent years to enhance productivity and restrain costs. And government has made a contribution through deregulation and through the absence of major initiatives that would involve higher business costs. Our adjustment process, by definition, has a counterpart for our trading partners. They must promote expansion in their demands and reduce trade barriers to assure active and receptive markets for exports from the United States and elsewhere. The buildup of imbalances occurred over a period of years and has involved major adjustments to the structure of economies here and abroad. These will not be reversed easily, but they must be addressed. We must resist the lure of shortcuts, such as protectionist measures which would only entrench inefficiencies and reduce living standards at home as well as around the world. We can make this difficult transition, and monetary policy has a key role to play. But if we are to have a chance of doing so without dislocations and detours in our national economic advance, we will have to work together to utilize all the tools at our command. Thank you, Mr. Chairman.
Mr. Chairman Greenspan, it sounds as though every time the Fed appears and qualifies the importance or tries to explain the difficulty in the new difficulties in interpreting the aggregate, such as M1, M2, etc., it sounds more and more as though what we need is a decoding machine. A decoding machine to be able to read what these aggregates really mean. But nonetheless, as you can see, we have two charts on the wall. One of the charts the one on the left, shows actual M2 and the Federal Reserve's target ranges over the last 4 years. As the chart shows, this is the first year where the Fed has failed dramatically to attain its target M2 growth. According to Section 108 of Humphrey-Hawkins' Full Employment Act, under which the Fed is required to report to the Congress, you are required also to include an explanation of the reasons for any revisions to or deviations from such objectives and plans for monetary growth. Now, the report that you've provided us is highly technical, as is usually the case.
I regret that that was required, but we were trying precisely to do what the law requires in that respect.
Right. But now, as I say, the report's very technical. I'm wondering if perhaps you could give us an explanation now, off the cuff, in layman's language that would tell us why the Fed allowed M2 to grow at a rate significantly below its objectives for most of the year, 1987.
As I recall, at the beginning of last year, when the Fed made its presentation here, it set up a series of ranges for M2, or just set up a range for M2, which was based on a forecast of interest rates, which were implicit in the targets and which are essential to where those target ranges are. In fact, the interest rate levels were somewhat higher. When interest rates go up, there is a tendency for people to get out of deposits and into market instruments where the rates of return are better. And as a consequence, as the year evolved, people who usually put their money into deposits felt that it was too costly to forego the interest rates they would get in other instruments, and as a consequence, they tended to take money out of those deposits and invest them in treasury bills or other different types of debt and even equity instruments. In addition, there was some evidence that the Tax Reform Act of 1986, which changed, as you recall, Mr. Chairman, the deductibility of consumer interest, apparently induced a number of individuals to forego borrowing in order to buy goods and dug into their deposits. The Fed, to my knowledge, did not contemplate that effect, and hence the numbers came in lower. Finally, towards the end of the year, we were really quite puzzled at why particularly demand deposits were creeping downward in a period when interest rates were now coming down and one would have expected them to go up, that is, demand deposits. And a survey was made, and it came to certain very interesting conclusions. It's technical, but not irrelevant to what actually happened. As I'm sure you're aware, Mr. Chairman, the tendency of most people who get business people and corporations who get services from banks will either pay for it by leaving interest-free demand deposits with the bank, or they'll pay fees. There appears to have been a tendency to go more towards fees than what we call compensating balances. And as a result, even though these compensating balances don't really affect spending because they're just sort of lodged in the bank and deposited there and are not used, these deposits nonetheless, of course, appear in demand deposits and in M1. So this shift away from compensating balances towards the end of the year was, I believe, a significant factor, especially in M1, as to why M2 and M1 did not accelerate much towards the end of the year. It is instructive, however, that after the first of the year, that we've had a rather fairly significant rise in the monetary aggregates, and this is suggestive of the fact that the interest rate sensitivity of these aggregates are becoming larger than we used to believe. And that, I think, is probably it's a long explanation, still unfortunately more technical than I'd like it, but the trouble with it is that's what causes money to change is technical, and I hope I was less obscure than in my written text.
My time is probably, our time is probably expired, but I wonder if you could just, on one of the points you made, where you say a lot of businesses, rather than individuals, rather than leaving or maintaining compensating balances in return for the services of banks, made a determination and decided, well, instead of doing that, what we'll do is we'll go to paying fees. Why?
Well, I think it's a long...
They can't deduct those fees? Or can they deduct
sure.
those fees as a business expense?
Yeah, they are a business expense.
Would that be one of the reasons?
Well, it doesn't really matter, because interest earned on deposits, or interest, I should say, earned on assets, is income and it's taxable, and fees paid to a bank for services are deductible. So there's no tax consequence as to whether or not you pay a fee or whether you place a compensating demand deposit.
Well, I thought you said that the compensating demand deposit was not interest-bearing.
It is not. That's what I'm saying. In other words, you're foregoing, for example, if I were a business, I would put, if I had to say a treasury bill, and I decided to put a compensating balance in, what I would do would be to sell the treasury bill, forego the interest, and put it into the demand deposits. So that in a sense, as far as the individual business is concerned, it doesn't matter whether or not whether he does one or the other. It matters for the bank, obviously, in the sense that the bank has to place reserve requirements on demand deposits now at 12%. With the Federal Reserve, and as a consequence, it sort of loses part of that income, and sometimes a negotiation occurs where the individual corporation will sometime be required to pick up indirectly part of the payment for reserves at the Federal Reserve, and it may well be that the long-term tendency towards fees is that businesses are beginning to suspect that part of what they're paying may in fact be that balance, the reserve balance to the Federal Reserve. So it's a long-term trend that's likely to continue.
I'd like to say that I understand totally.
I'd like to say that any of us understand it totally.
Mr. Wiley.
Thank you, Mr. Chairman. I'm glad to note that your statement in general is positive about our economy. The increase in real GNP you predict will be 2 to 2.5%. The inflation rate's likely to be 3.25% to 3 3/4%. Civilian unemployment not likely to go above 6%, according to your figures here. I note in a statement from Wharton Economic Forecasting Associates, recession fears have been heightened by recent data releases. However, while the economy remains very vulnerable, especially in the first half of the year, the fear of a recession may be overblown. This is the 63rd consecutive month of economic growth, and I'd like for you to comment on that in light of the statement here from Wharton Economic Forecasters as to whether you think that consecutive months of economic growth is likely to continue.
Well, this has been an extraordinary expansion, and I think to a very substantial extent it's been fostered, as I indicated in my prepared remarks, by the decline in the inflation rate. I think it's important not to actually take the longevity of a recovery and measure it by months in the sense that somebody's going to ring a gong out there at month X and it's all over. Okay. Because up until fairly recently, and in fact even now, the economy does not exhibit the geriatric characteristics of the very late stages of a business cycle expansion. We don't have that tightness in the markets and inflation accelerating and the types of pressures which usually precede an economic decline. And I think one of the reasons for that is that the competition that was pressed on us from imports, I think, created a lot of adjustments along the way in this recovery which forestalled the normal geriatric characteristics, if I can put it that way.
Very descriptive, I'd say.
Nonetheless, you know, we did have a large increase in inventories in the fourth quarter. That type of increase cannot continue. But we do not as yet see any indication that that is inducing a weakening, because where one would see it, first of all, would be in the order books of manufacturing corporations. And we just don't. The order books are solid, they're very strong. In fact, the numbers that were released this morning on durable goods, if one abstracts some of the temporary fluctuations, were really quite strong. In fact, orders for non-defense capital goods, excluding aircraft, were really very impressive. As a consequence of that, while we envisage sluggish growth for the period immediately ahead, there are just a very few signs that we're about to tilt over.
Thank you. French Finance Minister Edward Balladur wrote in this morning's Wall Street Journal, quote, "Last year's Louvre agreement marked the end of the floating exchange rate system." Do you agree with that, or is the news of that, like Mark Twain's death, slightly exaggerated?
Well, I think that what the finance minister says is clearly a view which has fairly widespread consensus around the world. There has been an increasing desire amongst the major economies, you should say more exactly, those who are finance ministers and central banks of the major economies, to seek more stable exchange rates. And the reason, obviously, is that the instabilities that existed in the 1980s created the type of uncertainties which I think most of us find unacceptable. The Louvre Agreements 1 and 2 were clearly an endeavor to achieve greater stability, and I think that's the consensus at this stage, and my impression is that that will continue, and I see no reason to expect any change in philosophy in that regard.
And you don't see any need to have an international conference on the issue? That's subject of some debate now.
Well, in a sense, we have a continuing international conference, in the sense that the central bankers of the world meet periodically with and without the finance ministers. One of the offshoots of telecommunications advances is that any of us can speak to any of our counterparts anywhere in the world with very little effort, and we do. So I don't perceive the need for any formal meeting at this stage beyond those which we periodically get involved with the Bank for International Settlements, or at the OECD, or the annual meetings of the IMF and the World Bank.
Thank you. Thank you, Mr. Chairman. My time has expired.
Mr. Neal.
Thank you, Mr. Chairman. Well, Mr. Chairman, on that point, isn't it true that really, when you think about some sort of cooperation between economies in terms of stabilizing currencies, you're really talking about basic macroeconomic policy, are you not, as opposed to...
That is correct.
Okay. You're not... I think we ought to make that clear. You're not talking about some sort of broad intervention or manipulation or using some external standard. You're really talking about trying to coordinate basic macro. And when you even on that point, it's really not a coordination. It's ultimately everyone's going to act in their own interest, I believe. And do you not believe that?
Well, I think that's correct. I would certainly subscribe to the way you phrase it, Mr. Neal. In a sense, there is no substitute for correct macroeconomic policies. Moreover, there is a growing awareness amongst the major trading partners in the world that one's domestic self-interest is tied to the world at large. And the basic purpose of economic international coordination is to try to phase our policies in a manner which help all of us. So it's cooperation to mutual advantage. And the basic purpose that we have in this country, obviously, is to maintain policies which maximize domestic long-term economic growth and employment in this country. But one of the ways that we perceive, that one of the ways that is what we must focus on in doing that is to look at how we interrelate with our trading partners. And that's the reason we are involved in the international economy, because it's crucial to us in the United States.
Well, of course I agree with you, but I think it's clear that, for instance, that we could not sustain the Louvre of kind of understanding when our own domestic economy reacted badly to it. And I think we're going to always find that to be the case. I mean, the Germans, we would like to see them expand more. They've chosen not to. What can we do about it? Well, nothing, as a matter of fact. It's in their interest, it's in our interest, but we can't force it. We don't have much time. If I may just shift. In your statement, you spent several pages on a discussion of some changes in interest rate behavior and the impact of interest rates on the conduct of monetary policy. Does that indicate some shift on the part of Fed policy, that you would give more weight to interest rates than you have over the last several years?
No. The reason for that is that I concluded that there is a great deal of confusion at this stage about the role of the monetary aggregates in monetary policy. And I'm concerned, frankly, that on the one hand, we will not understand why it is that the aggregates have veered off their usual course, and would conclude as a consequence of that we should abandon them. I think that would be a mistake. I think that
Yes,
it is
sir.
important, not only because we are legislatively required to do so, but I think it is fundamental to the policy of a central bank. I also, however, wanted to emphasize the fact that we have got to be very careful in evaluating these monetary aggregates at this time to be certain we understand precisely how they are interfacing with the economy, and not to focus on forcing them into a certain band irrespective of the consequences on the economy overall. So as a consequence of that, you are quite correct. I decided to spend more than what would usually be the case on trying to outline the technical reasons.
But there's no basic shift in policy.
There is no basic shift in policy.
One other quick question, if I may. There's something that simply I don't understand, and maybe the Fed could do some kind of study of this to help us understand a little bit better, but we keep hearing that the illicit drug business is at least $100 billion a year business, and maybe considerably more. We simply don't know. And if and a lot of this is a cash business. And, you know, the dollar is used as a medium of exchange in countries all around the world. Most recently, as pointed out, it's essentially the currency of Panama, for example, and of course you find it everywhere. It's desirable everywhere. And I'm just wondering if it's possible that now that there is a huge amount of American currency held permanently outside of this country, and that might help explain, in some minor way probably, this historic divergence that we see beginning in about 1985 between money and economic growth.
Yeah, it's interesting you should raise that issue, Congressman, because clearly that has been something which monetary economists have been puzzled by. We have looked at it in considerable detail, this particular issue, largely because I've forgotten what the per capita currency holdings of the United States are, like $900 per person, or some bizarrely outrageous number of that sort.
About 1,000. That's what I saw.
And what we looked at was the rate of growth in currency of less than, in denominations of less than $100, on the grounds that a goodly part of the underground and the behavior of all the illicit uses of American currency is likely to be concentrated in that chunk. Making those adjustments, we find that it really does not significantly affect those numbers. Nonetheless, there's no question that a very substantial part of American currency is not plain vanilla transaction balances for American households and business. That we know, and we try to adjust for it, and in the process of adjusting we find that there is no significant bias in our results relative to our ability to hold the aggregates.
Thank you.
Mr. Chairman, I hope you'll agree with me, and perhaps as a result of this question today, as time goes by under your leadership, the Fed might hopefully take a little more interest and aggressive stand to assist in this war on drugs, as far as watching where the cash is, where it's going. You know, we had a lot of questions about Panama for a long period of time, and the Fed sort of kept hands off as though it was, you know, it was a no-no. So I intend to be in touch with you on this as well, with my staff, so that we can see where the Fed can help, because I think that the Fed could do more than it has been doing in this area. And that's, I can't ask you to answer a question now. We'll go back to it on the next round when I get my second round. I don't want to impinge on other people's time. Mr. Schumer. Well done, Steve.
Thank you.
Steve, I'm glad you put that up.
Welcome, Mr. Chairman.
Good morning.
My first question is
They don't do it.
simply looking out over the next year, Mr. Chairman. Present course continues. Would you say there is a greater danger of increased inflation or a greater danger of falling into recession?
Mr. Schumer, at the moment, I would say that the dangers are probably equal. It's very difficult to judge. If I were to conclude one or the other, I hopefully would be arguing for a policy response to that conclusion, and I know of no one who can credibly make that judgment in a way which satisfies me.
Right. That is an answer that your predecessor would have given with the same pinpoint preciseness that you did.
I'm delighted it was clear.
Second question, on the Budget Committee and in the House, we are going to have to make a decision very shortly, which will be quite important over the next year or two in getting the deficit down, which, as you said, is probably the #1 thing we can do. And that is whether to use the projections of the Office of Management and Budget or the projections of the Congressional Budget Office in determining our budget. It's a lot easier to use the OMB numbers because they are so optimistic and do most of the job for us. Let me give you a few of them. CBO rates GNP growth at about 1.8%, OMB at 2.4%. CBO estimates the rate on Treasury 10-year bonds will be 9.3%, OMB 8.0%. I guess those are the two most, 3-month Treasury bills, 6.2% CBO, 5.3% OMB. As you know, most of the blue chip consensus is much closer to CBO than OMB. Would you agree that CBO's estimates are more likely to be accurate than OMB's?
There are certain questions which I suspect I would have answered readily as a private citizen and decide not to as a public official, and I suspect that is one of them.
Oh, come on. Should I try again? Well, I mean, does the Fed make projections on these?
Yeah, let me give you, the only thing I can give you is what the FOMC officially described as a forecast. We have, we are publishing, as I indicated, central tendency of 2 to 2.5% real growth on a fourth quarter to fourth quarter basis. Our inflation rates are 3.25 to 3.75 on the GNP deflator, and the unemployment rate is 5.75 to 6. What this does is puts us a shade below the administration on GNP, somewhat lower on inflation, actually, and
how about on the 10-year and 3-month notes? That's where. I mean, that is frankly where the administration's estimates are way out of line with everybody else's, and that probably has the most dramatic effect on how deep the deficit is. And you have the most to do with that one.
My staff has blanked out the numbers here. I can't read them.
Oh. One final question. On another issue that many of us on this committee have been concerned with, and that is opening up financial markets overseas. As you know, we've made a great deal of progress in the last year in getting Japan particularly to open up its financial markets to American firms that previously had simply been closed out. Many attribute part of that success to legislation that this committee passed and the Senate committee passed, which basically said to the Japanese, you can't become primary dealers if you don't open your government securities markets. One, do you think Japan has made some progress in opening up its government securities markets to Japanese firms? And two, what is your view of continuing the kind of pressure that this committee and the Senate committee has placed on Japan?
Well, I think that the Japanese have come a long way. I think considering the tendency towards isolation in their financial markets, they've moved a good deal into the whole framework of the international financial system, and I think they will continue to do so because I think they recognize that it is in their own interest. Much more importantly and more generally, I sense that they are, to a very large extent, recognizing the importance of their necessary role in the international community, and they have been endeavoring to integrate themselves more and more in the system. Obviously, we, meaning the United States, has argued strenuously that there should be more of that. I think we should continue to argue, and I think what we're going to find is that the progress they're going to make, have been making, is really quite impressive. They took, I think, extraordinary steps to join us in risk-based capital programs, and that was not easy for them. They are reaching out, and I think that's all to the good, and I would expect that to continue.
Okay. Mr. Chairman, my time has expired. I would ask, with the permission of the chair, though, that maybe by the end of this hearing, the chairman could give us answers on what the projections of the Federal Reserve are on the 10-year long-term bonds and 3-year Treasury notes for fiscal year '89. I mean, I think that's a number that should be readily available and may even be buried in one of these reports.
Mr. Leach?
I'm not sure the gentleman from New York isn't seeking private investment advice versus public policy, but
Gentleman from New York doesn't have much to invest.
fair enough. Let me just say, Mr. Chairman, it seems to me in a nutshell you've given a fairly optimistic view of the economy, but also indicated that in the event of a downturn, the Fed is prepared to be quite flexible rather than ideological, and I think most in this committee are fairly appreciative of that. My concern is that while you are right in noting in your statement that some sectors of the economy are doing rather well, for example, manufacturing and to some degree farming, the one area of the economy that is still quite vulnerable is the one for which you have a particularly direct responsibility for. And so in this regard, I'd like you to put on your regulator as opposed to economist hat and talk a little bit about the banking industry per se. And in this regard, frankly, it's reassuring to many of us in this committee that the Fed has finally moved in the direction that a number of us have urged since the 70s, since the late 70s, on an international basis towards risk-based capital. But in doing that and adopting, at least proposing guidelines along that of the Bank of International Settlement, it's interesting to note that it's not till 1992 and the end thereof that you have to meet certain guidelines. And it appears that nothing has to be done till the end of 1990, which is almost 3 years from now. And so my question is, given the overextension of some aspects of the financial community and the possibility of runs on some banks and in some parts of the thrift community, what equity increasing steps are you prepared to urge, direct, or coerce of the banking and thrift industry during the next 3 years? And secondly, what injunctions are you giving particularly the thrift regulators vis-a-vis the same? And thirdly, would it not seem reasonable to suggest that as we look at the possibility of new powers legislation, that a prerequisite for banks or thrifts to have access to new powers should be that at least at a minimum they reach the capital guidelines in their particular areas of current jurisdiction set out by the Bank for International Settlements?
Well, Mr. Leach, first let me say that any regulator looks at each individual institution with respect to capital adequacy, and where there's a perception that there's a shortfall, actions of a regulatory nature are taken to try to offset that. While it is technically true that the risk-based capital agreement extends for a number of years and doesn't require actions immediately, the markets are, in a sense, beginning to impose on individual institutions pressures which reflect the fact that they have not adequate capital in the context of 1992. And so, in a sense, even though there is this extended regulatory process, there is a set of market forces which effectively are bringing that up closer. So I'm not concerned that the length of time that is implicit in that is a problem, and indeed I think it is probably quite appropriate. And were we to perceive individual cases, needless to say, we act accordingly. So I don't think in any respect that we are lagging in areas where I think capital is required. And I don't think it's unimportant that the money center banks particularly have very sharply increased their capital in the last 5 or 6 years.
But most particularly in the last 6 months, they haven't, and most particularly in relationship to their liabilities, at least their, as we read about them, there have been virtually no improvements in many significant circumstances. And I would only make 2 points. One is, it strikes me the greatest mistake of the Fed in the last 25 years has had nothing to do with tightening or loosening credit at a particular juncture in time. It's had a lot to do with the failure to be, in a general sense, regulatorily firm on the international lending liabilities of the larger banks in the 70s. And it isn't simply a specific bank circumstance when there's a follow-the-herd mentality. But when we look at large banks with capital that doesn't come close to matching their developing country liabilities, I think a great question can be asked, can you afford to waste a lot of time? And 3 years is a long period of time. And I would only suggest that this is an awfully important issue for you, because the public doesn't want to be put on the line for bailing out private institutions, and as long as they can sell capital, sell stock, they have the capacity to raise equity. And there's none that I know of today that can't sell stock, and the only question in many's minds is they're apprehensive about stock dilution. But that's a private sector problem, not a public sector one.
Well, I agree with that, Mr. Lee.
And therefore, the query, when you appeared before here the last time, you noted that a number of banks were prepared before October 19th to issue certain stock. They haven't subsequently, which means in effect they're making a private sector decision that they don't want to dilute too much. But that has nothing to do with the public sector determination of whether they need greater equity. And my only urging is that you not put things off too long, or we could be in a greater pickle than might be suspected, even though in the abstract you set out guidelines that 7 years from now we should be better off.
Let me just say, Mr. Leach, that I think that the issue of capital is crucial not only for the financial system, but also for the non-financial system. And I must say that I've been making statements quite similar to yours for years, and I concur essentially with your basic approach. I think that as far as I can judge, the regulators are acutely sensitive to this question. I speak for the Fed, and I'm sure I can speak for the FDIC and the controller as well in this regard. And I don't think you will find us indifferent to the issue of capital adequacy in the commercial
on a short-term as well as medium-term basis.
I think we're just, yes, short-term as well as long-term.
Brad.
Mr. Chairman, I want to get back to the area of Mr. Schumer, because the question of the forecast that we use is very relevant. I voted against Graham Rudman, but I'm inclined at this point to, I think we ought to amend it, and instead of either CBO or OMB, we ought to have Jack Kemp make the forecast that would regulate us, and we could go home probably in April. But I think it is relevant, especially since the President's economic report contains two unusually clear-cut criticisms or differences of opinion with the Fed's action during 1987. The President himself on the bottom of page 4, when he says the prospects of growth in the immediate future have been diminished somewhat by last year's plunge in the stock market, as well as by the increase in interest rates and tightening of monetary policy during 1987. And in the report itself at page 44, the stance of monetary policy at the end of 1987 may have underestimated the risks to adequate economic growth. And I'd be interested in your response to those criticisms, but it also, I wonder why you don't want to answer Mr. Schumer's question, which I thought were perfectly good ones, about your projections on the 10-year and 3-month rates, partly because these two have led to reasonable questions about whether or not we're going to have some efforts in an election year by the administration to put pressure on the Federal Reserve. Now, I don't imply that that is unconstitutional. It's human nature. Any presidential group in an election year is going to worry about what happens to the economy, and they're going to worry about the Fed even when they have appointed all the members, virtually. You're not wanting to answer what seemed to be a pretty clear-cut question in this context. Are we getting more pressure? I mean, is it a problem that you don't want to give Mr. Spilkus? What's the situation?
Let me say this. I mean, first let me get to the issue of forecasting interest rates. I mean, for the Federal Reserve, which can affect interest rates, to forecast them would create a response in the marketplace which would feed on itself and create the types of reactions that I think would be adverse to the economy, so that it's not just a peccadillo of governors of the Federal Reserve not to forecast interest rates. I think that it's downright mischievous to do so and counterproductive, so we can't. On the issue of the tightness of monetary policy, that's a question of interpretation. And I would say that we did not perceive ourselves as being tight. We acknowledge that the growth in the monetary aggregates were slowed, but we think there are special reasons for that, and I think it's a mistake to interpret money supply as the sole criterion for monetary policy's effect on economic activity.
But at least certainly in the report of the Council of Economic Advisors, they talk about the stance of monetary policy. They're not talking about the aggregates. They're talking about policy when they say it appeared to underestimate the risk to adequate economic growth, and that seems to be the...
No, I can assure you, Mr. Frank, that when Burl Sprinkle talks about monetary policy, he's talking about the monetary aggregates.
You can assure me, but can you assure Mr. Sprinkle?
No,
when he says
Burl Sprinkle is...
When he says monetary policy, he means then nothing that you had any control over? I guess I'm confused about this.
No.
Or does he think you have more control over the aggregates than you have or than you think you have?
I'm sorry?
I mean, why does he say, you talked about the monetary aggregates and you explained to the chairman that there were factors over which the Fed didn't have a lot of control that accounted. That was the inference I drew. Now, that would be a strange way for Mr. Sprinkle to talk about it when he says policy. Policy implies conscious decisions by the Fed, not with 100% accuracy. But there does seem to me a gap here. It does not seem that he's talking about the kind of things you were talking about, which were technical factors over which the Fed didn't have a lot of control. He's talking about conscious decisions.
I don't want to talk for Dr. Sprinkle, but I know him very well, and I will tell you basically my interpretation. His basic view, as indeed all who are monetarists, and I consider myself sort of part monetarist at least, believe that the central focus of policy is the monetary aggregates, and that they can be controlled. We could have controlled the aggregates in a path over last year, which would have been which would have grown much more rapidly than they actually did. But we could not have done so, in our judgment, without creating an unduly inflationary environment. There is a difference of opinion between Dr. Sprinkle and myself on this particular issue. I mean, it is a technician's evaluation of precisely how the monetary aggregates at the moment are interfacing in the economy.
How that's going to play out for the year, because one of the things that gives people concern is having the chairman of the Council of Economic Advisors, with the president sort of siding with him in this report, having this difference, which may start as a technical one, but there's clearly a policy difference. Where are we going to go? Are we going to see some pulling and hauling between yourselves and the President's economic advisors this year, or have you worked this out? What's the situation?
Well, I mean, recently, Dr. Sprinkle has said he's satisfied with what the current policy of the Federal Reserve is. And the reason he is that money supply growth has turned back up fairly significantly in January and February. Now, at the moment, we're all looking at the same thing, and I suspect there are no differences, but it is certainly the case that we do evaluate the 1987 experience differently from the way he does, and that's an economist's disagreement for technical reasons. I respect his view. he respects ours.
My time's up.
Morrison.
Thank you, Mr. Chairman. Mr. Chairman, I'd like to shift focus, if we could, to another issue that's going to be before this committee during this year, and that's the general capital increase for the World Bank. Last week you spoke publicly about it and endorsed the $75 billion GCI that we're going to be considering. And I have no problems with that as far as that goes, but in the context of speaking about that, you essentially endorsed as a debt relief strategy what's come to be known as the Baker Plan. And your particular emphasis was on increased lending by the IMF, the World Bank, and the commercial banks. And I guess my first question is, do you really believe that our commercial banks can prudently expand their level of exposure in the Baker 15 countries, for instance, in terms of the risk to recovering 100 cents on the dollar from what they loan?
Well, first, Mr. Morrison, remember that all of the discussions on lending that now occur with respect to expanded lending are really, in one form or another, loans which enable interest payments to be made. And as a consequence, in one sense, the net new exposure, which one often would interpret as over and above interest payments, is not involved in any of these packages, nor is it requested by any of the individual debtors. What we're looking at this particular stage is basically a means to restore these debtor nations to access to the international financial markets, because if that can be done, and I believe it can, then the commercial banks would be far better off than any of the other schemes that I have heard.
Could I just interject there? I certainly think you're absolutely correct. The new lending we're talking about from commercial banks, at least to this time, although not as originally proposed by Secretary Baker in Seoul, who proposed massive new lending above and beyond interest payments, but it is true that what so far we've been doing is essentially seeing the money supplied by the banks to pay the banks what they were owed in terms of interest. But you would have to concede that that does increase by substantial amounts of money the exposure of those banks in those countries. In other words, that money is now owed on top of the money that the interest is being paid on.
Well, the problem basically is where the money is going to come from. In other words, we really are not confronted at this particular stage with an issue of payments being made by the debtor nations to the commercial banks on a fully funded basis, on a regularly normal basis. What has occurred since the 1982 crisis is, in one form or another, we've had to either reschedule or do various different forms to assist the banks and the debtors, each joining in various different relationships, assisting themselves really, to find a better accommodation. What has occurred here is, what our options are at the moment is either one form of rescheduling or another. A number of these so-called debt forgiveness schemes, which I hear about, or trying to do something which follows on from the Baker Plan. In my judgment, as I said at this Bretton Woods committee grouping, which you quote me on, there is no substitute for appropriate domestic economic policies on the part of the debtor nations. If we don't get sound policies, then we will find that whatever we do is going to be a problem. As best I can judge, there's a general awareness now, and it's growing amongst the debtor nations, that there is no substitute for their own viability other than taking sensible economic actions.
Well, I think that we're certainly in agreement there. Let me ask you whether you support the Morgan Guarantee Mexican approach to some degree of restructuring of the Mexican debt.
Well, I think the particular vehicle to which you refer, which is effectively an exit bond, is one of a number of voluntary devices which are being set up, which I think are useful. It is not something which is a solution to this particular problem, nor was it ever presumed to be. And as a consequence, I think it is a definite plus, and more vehicles of that nature, I think, would be useful.
The impact, there are a number of things that are true about the Mexican plan, but one of them is that there's a market-established discount, a process to establish a market value of these, call them exit bonds if you like, and a recapture of that discount by Mexico. Do you support that concept, and do you consider that to be debt relief?
Well, remember that so long as it's voluntary, that the banks are essentially voluntarily switching instruments, claims, with the debtor country, and in that sense it does obviously reduce the debt of the debtor nations, and slightly at least reduces their debt service charges. But the crucial point here is it is not mandated by governmental actions.
But do you support it?
Yes, I certainly
And do you consider it debt relief? Or what name would you like to give it?
I would say it's an exit bond.
Okay. It's just, I hope we'll have, my time has expired, but I hope we'll have further opportunities to discuss this issue, because in fact, the International Debt Management Authority proposal that was passed by this committee and by the House of Representatives and by the Senate, and is now in conference, engages in the same form of voluntary, market-based reduction in interest and overall debt obligations on the countries, and I think has been unfairly attacked as some kind of compulsory and non-market scheme, and I hope we'll have an opportunity to review
the gentleman will have an opportunity because we will have a second round.
Thank you.
Mr. McCollum.
Thank you, Mr. Chairman. Chairman Greenspan, in any growing economic environment, I guess a rate of inflation of some sort is expected, perhaps the 3 to 4% that we've been talking about this morning. But there is some point at which it's an unacceptable level. 10%, 15% certainly is. What I'd like to know is, in your view, where does that margin lie? Is it 5%, 6%, 7%? Where do we get into trouble?
I think 3 to 4% is unacceptable in the sense that once you accept it, it'll start to grow on you. We don't know where the accelerating trigger is, but as I try to emphasize in my testimony, you've got to be careful and not become complacent about even 3 or 4%. Remember, President Nixon imposed wage and price controls when the Consumer's Price Index, as I recall, was 4.5%. So I wouldn't want to give you a number which is any number I would give you certainly would not be in excess of 3 to 4%.
But you're not worried about the 3 to 4% in terms
No,
of
I'm
the
not
present?
worried. No, the answer is, of course, I'm not worried, because we don't see any imminent acceleration. But I also know enough about history that inflation sneaks up on you fairly quickly, and you're not aware it's there till it's got you, and then it's too late.
What you're worried about is it doesn't just hit 5%, it suddenly runs away, and that's the bottom line. The merchandise trade deficit has declined over the past 2 successive months. How do you feel about what's going to happen next if we finally turn the corner in the trade deficit?
I would be hesitant to forecast individual monthly data. I think they will continue to be unstable because it's in the nature of the way the data are collected as well as the way the system functions. But I do think we've turned the corner. I think we are trending downward. I think it will be slow and erratic.
In terms of the trade deficit and looking at it in comparison to our federal budget deficit, Mr. Chairman, in your view, your personal view at least, at this juncture in our concern over the economy, which is more critical, to reduce the trade imbalance or to reduce the federal budget deficit?
I think the trade balance is on its way to adjustment and will adjust because of market forces. The budget deficit is a discretionary item of economic policy, and it's by far the more important of the two, if for no other reason than how the federal budget deficit is resolved will significantly affect the trade deficit. So if I had to choose between the two where emphasis is, I would, without question, put the very heavy weight on getting the budget deficit down.
I can remember in the past having discussed with Chairman Volcker the relationship, but for our edification, could you just briefly elaborate on why the federal budget deficit is important to the trade deficit? Well,
it's a complex answer. During the 1980s, when the budget deficit began to take off, it moved real interest rates domestically significantly higher. And that in turn created a very major increase in the dollar in foreign exchange markets, which in turn opened up the trade deficit quite considerably. The problem is that it doesn't work symmetrically all that simply because there are so many other complex issues involved. But overall, I would think that the basic problem is that you cannot have simultaneously these two deficits out there concurrently. Both have to come down. I don't want to give you an explicit, simple answer because there's so many complexities involved in here.
But it's definitely related, and you said that.
But only in a very general way. I mean, I don't want to overemphasize the tie between the two because over history they have not been all that closely related, nor in country after country are they exactly related. It's only under certain circumstances.
But they were when the history of this particular trade deficit began to build.
That's correct. This particular trade deficit, I think, opened up largely because the federal budget deficit opened up.
Let me ask one last question. When you discuss any of this, we talk about the value of the dollar always. It seems like we come back to that. It seems to have stabilized in a range now as opposed to where it was the last time I think I had the privilege of seeing you before our subcommittee, the very first time we had any testimony. Are you comfortable with the current status of the dollar on the world market?
Yes, I am.
Thank you, Mr. Chairman, and thank you.
Ms. Kaptur?
Thank you, Mr. Chairman. Welcome. Good to have you this morning. I have two requests and two questions. The first request is I'll be going to Taiwan and South Korea in early April, and I'm wondering if you and your staff might provide me with some recommendations that I could use with those two governments and how to encourage them to get their currencies to float.
We'll be glad to make
that would be most helpful to me so I can make an intelligent statement or two. Secondly, in your testimony in the blue attachment and in several other places, on page 4 here specifically, you refer to the fact that some increase in personal savings in the United States would be beneficial to the economy. And as in your position as chairman of the Federal Reserve, I would appreciate hearing back from you and your staff on what the Federal Reserve is doing to encourage its member institutions to encourage savings in the American, on the part of the American people. Example, I go out to grade school audiences in my district and ask how many of them know what a credit card is, and all the hands in the room shoot up. I ask them how many of them have savings accounts, and less than a third raise their hands. Less than 2 per class know what a credit union is. I asked Mr. Corrigan of the New York Federal Reserve this very same question when I was up in New York, and he made the statement to me that the American people have to learn how to save more. And I contend that the Federal Reserve has some responsibility in helping to lead that charge. You can't even get those little penny savers or quarter savers anymore in the major lending institutions of this country, although most lending institutions are encouraging their customers to get the plastic credit cards. So I really do believe there is a role for the Federal Reserve in this regard. I asked the same question of the head of the ABA who was up before us a couple weeks ago, and he said, well, of course member institutions don't do it because it's a loss leader. And I guess I have a personal interest in this. I just got a notice from one of the banks that I have a checking account with in my district. The largest bank holding company in my district just sent out little notices that say if you don't maintain $1,500 in your checking account, your service fee will go up to between $6 and $8 a month. And I say to myself, are they really interested in small savers? Not that I would be classified as a small saver, but it would obviously discourage anyone who wanted to maintain a small savings account in that institution. So I would greatly appreciate a reply back from you, Mr. Chairman, on what the Federal Reserve might do to encourage member institutions to promote savings in their respective institutions. That's it on that. I also wanted to ask your judgment, switching gears here to another area. I'm trying to understand what % of our interest rates are dependent on external borrowing and the interest owed thereon. Do you have any sense of how much of our real interest rates at this point are tied to interest payments due to money that we have borrowed from foreign sources? And if you don't have that information right away, just know that I'm very interested in that. And how in the world do we wean ourselves off our growing penchant for foreign credit?
It's an interesting question. We have not, to my knowledge, done any, try to make an evaluation of what part of the nominal or the real interest rate that we currently pay in this country is attributable to our external balance pressures. We'll try to give you some judgment on that. I'm not sure we can, but we'll take a look at that. The major problem that we have got is that we are consuming more than we are producing, and we're borrowing several percentage points of what we consume from foreigners. It's their savings that we are consuming, and obviously we have to, as you put it, wean ourselves off that. That's the same thing as saying we have to reduce our current account deficit, because that's where the savings are in a sense flowing through. And as I try to outline in the official statement that I have read, and it also appears in this particular book, and our policy is directed towards that international adjustment process, and we would consider that it would be quite successful were we to succeed, as you put it, in weaning us off foreign savings, because we cannot assume that they will always be there in the volume that they are there.
Thank you very much. I look forward to hearing from you. Thank you, Mr. Chairman.
Mr. Kennedy.
Thank you, Mr. Chairman. Hello? Yeah. Mr. Chairman, you indicated in your testimony that there are some difficulties in using the M1 as a useful measure of growth in the economy, partly because of distinctions between transaction accounts and traditional interest-bearing accounts. On the other hand, it seems that one of the basic parameters that it is used by the Federal Reserve is the unemployment rate. And yet one of the things that has come up about the unemployment rate, which is pegged at 6% or thereabouts, is that obviously people are no longer held on the rolls of the unemployment rate, number one. Number two, that in particularly in the inner city, we see unemployment rates of over 50% amongst certain groups. And I would just think that if you look at some of the economic analysis of the jobs that have been created by over the course of the last 6 or 7 years, most of the studies would indicate that fully 60% of those jobs pay less than $7,000 a year. And I just wonder whether or not there might be some better way of judging what kinds of jobs are being created by the U.S. economy and by the administration. If we're able to move off the M1 account, are there some better measurements of unemployment that really reflect U.S. position in the world?
Well, Congressman, remember that what we at the Federal Reserve can do is only deal through the monetary system. We are aware of the issue of the structure of unemployment. We recognize that there's really very little that monetary policy can do to change that internal structure. As I've said here and previously, I look at the goal of monetary policy as maximizing the long-term economic growth and employment in this country. That is the sort of the fundamentals with which we deal. And a necessary condition that that be achieved is that we don't allow inflation to take hold, because that'll destroy jobs faster than anything that I'm aware of. We look at the unemployment rate as a measure of capacity utilization within the economy as far as monetary policy is concerned, but are, as you point out, fully cognizant of the fact that it doesn't always mean what you think it means, because there are different types of unemployment and there are different types of pressures on the labor market at any given level of unemployment, and we try to make that adjustment. I think the job patterns have been actually not too bad, in the sense that I'm not sure that they are always as good as we would like, but we've gotten significant increases in manufacturing jobs recently, and I would think that you know, if you look at the employment trends in the last 5 years, the most rapid growing area is in computers and data processing in the services area, which is up 15% at an annual rate.
Yeah, but that's exactly the point I was trying to make, is that a lot of those service jobs, sir, go from a manufacturing job to a service job. You're going paid from $12 an hour down to $4 or $5 an hour. And if that's not reflected in if you're using two basic parameters, the inflation rate and the unemployment rate, to make your overall decisions, if in fact what you've got is a ratcheting down of the unemployment rate, but a hidden factor, which is that the salaries being paid are in fact greatly reduced, then it seems to me you got a problem that's not being taken into account by a lot of academic numbers.
Yeah, no, I understand that. That would show up, if it were the case, in a decline in real average hourly earnings, and we don't get that. In other words, we're not getting the type of extended decline which implies a big shift. It is true that we're not growing the way we used to, even years ago, and I think that there's no doubt that we all would like to see much better job structure than we're getting, but I think the numbers are not as bad, if you look at it in detail, as some of what I think the concerns of a lot of people are.
Just to let you know, sir, when you go out into a lot of congressional districts around this country, that is not the feeling you pick up out there.
No, it's true. In individual areas, you're absolutely correct. There's no doubt about it. I'm just saying is that it's offset by other areas of the country in which it is not true.
Yeah, well, my area is supposed to be doing very well, and a lot of service jobs have been created. I'm just letting you know things aren't necessarily quite as rosy as they might come across. I'd just like to try to get a second question in, sir, which is, you indicate on a response to a couple of questions that the federal budget deficit really is at the root cause of a lot of the economic problems that we're facing. And it just seems that if that is the case, that what we're really looking at is tax rates being reduced from 70% for the wealthy down to around 30, 33%. You see corporate tax rates being reduced 46%, 34%, whatever specific numbers you want to use. It just seems that you know, whether or not we really want to squeeze that last $150 billion of discretionary spending is where we're going to get these kinds of savings to offset the deficit, or whether or not, in fact, you're prepared to suggest that we reached the time to call for new taxes.
Well, the trouble that I have with this moment discussing the solution to the budget deficit problem is that there are no new insights to this issue. I think we're all acutely aware, and we've debated them at great length. All I'm arguing for is that we resolve the budget deficit issue, because I think
we got to get elected. He's got to get elected.
Well,
the other candidate doesn't have to.
Time of gentleman has expired. Mr. Parrish?
Good morning, Mr. Chairman. As we speak, Wayne Nagle government, or the governor of the Federal Reserve Board, is addressing the National Council of Savings Institutions at a meeting downtown on the subject of allowing commercial banks to acquire healthy S&Ls. Is he speaking for the Fed, Mr. Chairman, and can you indicate to us what he's going to say this morning? Is that the Fed policy?
I'm sorry, you're talking about Governor Angel? Is that
Angel, yes.
I have not seen what he's going to say, but I think that the usual procedure is that the governors in their prepared remarks dip into the pool of agreed positions, and with rare exceptions, unless they specify otherwise, the governors speak for the Federal Reserve.
Well, the Fed made this proposal last September. Can you tell us what the status of that proposal may be at the moment?
We are still examining the issue and have not made any decision on it, Mr. Parrish.
Thank you, Mr. Chairman. Just one question I have this morning, Alan. The United States is clearly living beyond its means. I don't think anybody quarrels with that. The current account deficit, which you've already reviewed, the budget deficit, we have essentially full employment most places in the nation. Spending is concentrated in consumption, savings at a new historic low, etc. I have heard your predecessor, Mr. Volcker, for whom I'm sure all of us, including you, have a high regard,
Indeed,
have indicated that we must live or anticipate living off of foreign capital for some time. And if memory serves, he said something like 5 years or thereabouts. 1987 capital inflow was essentially from governments and foreign central banks, and is a net zero in terms of increase. Now, my question, Alan, is very simply, if the United States needs more exports and less domestic consumption, less imports, and more capital investment, if in fact there is zero increase of foreign capital available from private sources, and we have taxed the ability of foreign central banks to provide that, where is the investment capital going to come from a foreign source over the next 5 years?
well, let me say that the historical fact is that the very substantial part of the current account deficit in the United States was financed last year by foreign central bank purchases of dollars, both directly from American residents and indirectly through the euro currency markets.
But is it not correct that it was a zero in terms of private investment sources other than foreign governments?
I don't think it was quite zero.
Well,
but it's,
essentially.
There's a technical problem of how you evaluate and measure the total accumulation in the euro currency market. But as a practical matter, it doesn't. I agree with you. It doesn't matter.
Okay.
However, that's not been true since the beginning of the year.
Of this year?
This year. In other words, one way of looking at what's been happening is that there has been an obvious significant increase in the proportion of private savings financing the U.S. current account deficit.
Well, we're only like 7 weeks into this year, Mr. Chairman. Do you anticipate that that'll continue to be true for the balance of this year, for instance?
I would say substantially, yes.
And is that a function of the exchange rate adjustment on the dollar?
I think it's essentially a function of the willingness on the part of foreigners to accumulate dollars. And since the markets know in advance roughly what net production of new dollars there will be to finance a current account deficit, that's discounted. And unquestionably, one of the reasons for the pressures on the downside in recent years on the dollar has been to adjust for that. I think we have clearly gotten to a point where foreigners feel far more comfortable about holding the dollar at these relationships with respect to exchange rates and interest rates.
You make mention on page 18 of your statement this morning that our trading partners must promote expansion of their demands and so forth, and not resist the lure of shortcuts, such as protectionist measures, entrench inefficiencies, and so forth. Would you agree, Mr. Chairman, with the observation that the protectionism route is the most dangerous way to attempt to correct our trade deficit? That if we can do it without risking inflationary results, recessions, and all the rest of it, that there's much preferable ways of doing it, including, I gather, your suggestion that we reduce trade barriers around the world.
Yes, sir.
And protectionism is, however you define that, is the last way to go, isn't it?
I don't think it would solve the problem. I think it would be counterproductive and policy which I think we would regret.
And surely lead to retaliation.
Certainly.
Thank you, Mr. Chairman. I appreciate it.
Ms. Pelosi?
Thank you, Mr. Chairman. Mr. Chairman, following the crash in October, some of us were invited to New York to talk to folks up there and see if they could shed some light on what actually happened. In the course of that, some questions arose which I hope you'll help answer today. On one part of town, people would say, it's very important for you people in Congress to understand that you must reduce the deficit. And then across, on another part of the street, they'd say, you must reduce the deficit, but not too fast. At the New York Stock Exchange, they said to us, we can be optimistic about the economy in 1988 because we believe people will spend. And at the Federal Reserve Bank, we were told our optimism should spring from the fact that in 1988, people would save. Can they all be correct? And if so, who is more correct?
No, they all can't be correct. I must say, personally, I'm not concerned about how rapidly we reduce the federal deficit. The argument basically for too rapid reduction is that reducing the federal deficit withdraws purchasing power from the economy, and if you do it too rapidly, then you'll bring the economy down. I must say I cannot conceive of the Congress or the administration jointly reducing the deficit so rapidly that is a concern. Anything that the Congress and the administration can agree on with respect to the reducing the deficit is almost certainly not excessive from an economic point of view.
My second question is an international one. Much has been written about the Japanese and how much of their success is attributed to the fact that their managers look to the long term versus the U.S., where many of our managers look to the short term. Could you just briefly address what you think as more of a factor contributing to this, the cost of money or the Pavlovian reaction of Wall Street for poor quarterly earnings report?
First, I think that there's some exaggeration in that view. There is, however, some root in it that comes basically out of two different cultures. The Japanese have exhibited a much higher propensity to save than we, which is another way of saying that they are willing to value the longer term more than we are. And when you convert that into corporate evaluation, the higher rate of savings and the so-called implicit lower cost of capital that occurs as a consequence of that induces Japanese corporate management to be willing to invest for the longer term to a greater extent than we do. It's not business per se which is relevant here. It's a culture, which is the total propensity to save in both societies and the effects and what that does to an economy and what it means about the value preferences of the system.
Mr. Chairman, just very briefly, thank you for your response. Just very briefly, what is your interpretation of the Louvre Agreement?
My interpretation?
I have some difficulty isolating exactly what that means. I read so many different things, and I just wanted to know what your operating definition of it was.
Well, there's been a general agreement amongst the G7 to stabilize exchange rates and to do so through coordinating basic economic policies. And that's our goal, that's what we are endeavoring to do, and I would say to date, I think it's been generally successful as an activity.
Thank you.
Mr. Travis-Boulmay.
Thank you, Mr. Chairman. Good morning, Mr. Greenspan, and thank you for making yourself available to this committee for these discussions on this range of subjects. I'd like to go back to the idea and the discussion on debtor nations and to sort of elicit from you, if I could, your own perceptions and opinions on what might be happening and what could happen. When I look at attempts to manage the debt, there are, at least as best as I can see things unfolding, several courses that have been taken or several courses that people are proposing to take. We look at what happened with the Mexican Morgan guarantee situation. There are countries now saying that's something that they'd like to pursue. You call it an exit bond, they call it something else, but they're talking more about that. There are other nations that want to go back and renegotiate in order to reschedule their debt so that they're able monetarily at home to do some of the things they want to do. And then there is a group of nations that assume that their debt is so small that it ought to be forgiven. What is not being talked about that often, though, is what happens in the case of a self-imposed moratorium, as is the case with Argentina some time ago. I know you don't have a crystal ball, but if you did, and if you were to look into it, do you see moratoriums by governments increasing over the next several years? And if so, what can financial institutions here and perhaps even this government do to avert them? Do we look at doing more rescheduling? Do we look at doing some forgiveness? Do we try some other means to get out of it?
Well, we had a very interesting experience with the Brazilian moratorium last year. As you recall, that about a year ago they imposed a moratorium on interest in principal. And for a very short while, I think they thought that it was a desirable policy on their part. I think it is very instructive that early this year, the new finance minister, Dano Brega, concluded on the basis of a year's moratorium that was quite counterproductive to the Brazilian economy. One, because it accelerated capital flight from the country. It significantly reduced so-called trade credits and interbank deposits, and net on balance, the conclusion of the Brazilian finance minister was that the moratorium was actually negative for Brazil. And they, as a consequence, have moved towards negotiations which will restore their normal international financial relationships. I think the experience that Brazil has had and their perceptiveness in being able to see precisely what the impact was has hopefully put moratoria, so to speak, well on the back burner in all these international financial discussions. The only way, as I indicated earlier, to resolve these issues in a way which keeps the credit standing and the capital flows going to the developing nations is to resolve this issue in a manner which does not induce a unilateral withdrawal from participating by the commercial banking system of the world. If that happens, then I think we are going to find that the debtor nations are in very serious long-term difficulty.
Has the Fed taken any formal position regarding what you advise banks to do in similar situations where there is long-term outstanding debt? I mean, do you advise rescheduling? Do you advise working out the exit bond that you refer to, again, that others refer to as the debt equity swap? Or do you just allow them to make their own decisions without any input?
Basically, the decisions have to be theirs. If they're not theirs, then they are involuntary and the result of pressure from the federal government, which we think would be most inappropriate and actually counterproductive. We try to be helpful in the sense that we're glad to discuss issues, and we do try to enhance the dialogue where we can, but we are very careful not to impose ourselves, because I think that were we to do that, we would find that we would then become the key player in the system, and it would probably unravel all of the progress which has been made to date, and in a sense almost require that either the Federal Reserve, the central banks generally, or governments get in to resolve this issue. And were that to happen, I think it would be to the detriment of the developing countries and the debtors.
Thank you, Mr. Chairman.
Mr. Hyler?
Thank you, Mr. Chairman. Mr. Chairman, monetary policy is intended to try to promote price stability. And at different times during the course of the Fed's history, the Fed has used different criteria for defining price stability, or at least coming up with different means to achieve that goal of price stability. I can remember in previous hearings where the opinion was voiced that things, not only were the M's looked at, which of course is a focus of your discussion today, but capacity utilization, unemployment, auto sales, you name it, lots of different things were used as a crystal ball to try to indicate what would be the case with future price stability. I wonder if you might be able to tell the committee what type of attention and what type of focus you place on commodities prices.
We've done a good deal of analysis on the relationship between commodity prices on the one hand and the general rate of inflation on the other. And I must say to you, somewhat to my surprise, we have found that there are some leading characteristics of commodity prices, not a great deal, but some. At the moment, we don't find that they are signaling any acceleration of inflation. And we see very little in the way of inflation acceleration from the current modest 3 to 4.5% range, depending what type of period or statistics you use. The trouble, unfortunately, is that the forecasting capability of commodity prices, while there, is weak, and the general capability of forecasting the onset of an acceleration of inflation is poor, which means that we have to be very careful, because once inflation gets hold, it is very difficult to restrain it. And that's the reason why, while we don't at the moment see an acceleration of inflation in any of the data that we are looking at, we nonetheless continue to be vigilant, because we know when it starts, it can happen rather quickly, and it sometimes can sneak up on you in a way which you're unaware of.
In the past month or so, the price of gold has fallen in the neighborhood of $40 to $50 to $60. Do you look at that as a bullish sign in terms of price stability?
Yes, I do, Congressman. I think that whatever one may say about the price of gold, it does historically have a position in the inflation evaluation process which is useful, provided that it is not looked at as a sole criterion and without looking at the particular reasons why the price of gold moved. But there's no question that the decline in the price of gold from near $500 an ounce to something over $440 an ounce now is essentially a reflection of a market's perception that the inflation outlook has eased.
Treasury Secretary Baker has said in previous occasions that the development of some type of a commodities index that might include something like gold might be something worthwhile pursuing as an indicator of future inflationary expectations and obviously the resulting effects on the conduct of monetary policy. Do you subscribe to that? Do you think, is that something that you at the Fed actively look to or try to develop on your own?
Well, Congressman, let's remember what the actual purpose of Secretary Baker's proposal was. The specific concern that the Secretary had was that we were looking for some integration of exchange rate relationships which stabilized individual exchange rates through the Louvre Agreement. The trouble, however, is that it is possible to have every country with a 50% inflation rate and still have stable exchange rates. Clearly, that's not what anyone had in mind. And you therefore need a measure which essentially looks at the total exchange rate structure relative to prices of goods. And the purpose of trying to find a series of internationally traded commodities, including gold, and monitor them was for the purpose of looking at that process to make sure that in the goal for exchange rate stabilization, we were also looking at the issue of all currencies being stabilized relative to prices. That was the key purpose of that. And we at the Federal Reserve look at that in that context. We don't, we're not slavishly tied to commodity price evaluation as it might affect monetary policy, but we surely look at commodity prices as we look at a wide variety of other indicators to tell us what the state of the economy is doing and what the impact of monetary policy is.
I thank the Chairman for his testimony and yield back the balance.
Mr. Chairman, in 1986, the Congress adopted Public Law 99570, and one of the sections of the Act provides discussion on international information exchange system. The Secretary of Treasury, in consultation with the Board of Governors of the Federal Reserve, shall initiate discussions with the central banks or other appropriate governmental authorities of other countries and propose that an information exchange system be established to assist the efforts of each participating country to eliminate the international flow of money derived from illicit drug operations and other criminal activities. The B section of the Act requires this report on the results of discussions initiated pursuant to Section 1363A. Now, in this report, it states, among other things, page 7, the Treasury Conference on Money Laundering. And I quote, a number of countries evidently still perceive drug trafficking and money laundering as issues that undoubtedly concern the United States, but that are not truly problems of general concern to the international community. That's quite an attitude. Now, to aid in fostering the spirit of international cooperation between the United States and other countries in combating money laundering and to address the perceptions of some countries about the seriousness of money laundering, the Secretary of Treasury has approved a plan to hold an international conference on money laundering in Washington, D.C. in late 1987. I'm told it was held. We didn't get a report, did we? Now, this is dated July 29, 87. The conference was held I assume the Fed attended. I assume Treasury attended. Others attended. We haven't had any report on it. Now, the Fed was supposed to be discussing with other nations, the central banks rather, primarily at Basel, and this is at the suggestion of Interpol, this interchange of information. We've heard nothing. And, you know, I mean, the silence has been deafening. And so I'm asking you at this point in time, Mr. Chairman, I mean, you know, you don't have enough to do. I realize you said no, you didn't want the recommendations of the Brady report as far as overseeing the SEC, et cetera. Well, that's fine, but you've already got this one. And therefore, I would ask that we see a little activity here because there is a great deal of concern in this area, and I think it's of utmost importance.
We will look into it, and we will be back to you, Mr. Chairman.
Thank you. Now, one quick question. The newspapers and the academic journals and country club locker rooms are full of stories about the United States' position as a debtor nation. This Sunday, the Washington Post ran an article that said, and I quote, "Foreigners now own United States assets of over $1.7 trillion. Now, as an economic policy maker, is the fact that the United States is the largest debtor nation in the world bothersome? If not, why not? And what problems or benefits does this pose to the Fed in its conduct of monetary policy?"
I'm not concerned about the ownership of properties in the United States which are productive, produce jobs. I do think that there are certain risks about when one is effectively when one's currency is the reserve currency of the world, as of course ours is, when there are vast holdings of dollars external to the United States, because it's very obvious that changes in the propensity of foreigners to hold dollars relative to other currencies has an impact on exchange rates, and through exchange rates on interest rates, and through interest rates on our domestic economy. And as a consequence of that, it clearly creates a considerable amount of difficulties for us in the event that our other policies are unsatisfactory. If our overall economic policies are sound, then we are unlikely to find that the holdings of debt, American debt, by foreigners is any problem at all. In fact, they would probably be holders who would be quite content in their position. The difficulties arise when something goes wrong here, adverse, such as our budget deficit, such as the onset of inflation, and we begin to get changes in attitudes towards holding dollars abroad, which is, of course, what we mean, in part at least, by having an external debt. And that induces a considerable amount of adjustments here that we must take. In other words, it exaggerates the impact of adverse events in the United States by having a very large external debt position. When things go wrong here, they will go wrong with a greater degree of virulence if we have a heavy external debt than if not.
Thank you, Mr. Wiley. My time expired. Mr. Wiley.
Thank you, Mr. Chairman. I'd like to follow up on that. There may be a psychological negative. There is some concern among my constituents about foreigners holding American debt, may I say. And Mr. Schumer and I put in a bill which was passed by the House to require an accounting of assets held by foreigners. What's the status of that over in the Senate, Chuck?
Yeah, Mr. Wiley, Senator Moynihan is the sponsor there, and he thinks it's going to move this session.
What do you think about a bill like that, Mr. Chairman?
I feel very uncomfortable about restricting the investment in the United States by foreigners. I think that we
doesn't restrict the investment. It just calls for an accounting. It would call for public accounting.
Well, the net effect of any forms of accounting tends to be at the margin restrictive. It's hard for me to imagine any accountability legislation which is not perceived by foreigners as being restrictive, and hence they would tend to stay out even if that was not the intention of the bill. I think that we ought to take a lesson from Europe. We invested very heavily in Europe after World War II, and in my judgment it was a major factor in the extraordinary recovery of Europe, and that indirectly that investment created jobs, standard of living, and growth. And I think that it would be a difficult problem for us if we were to prevent that type of flow of investment from occurring here. We collect the data, and have for a while, on this type of investment in very great detail. I've looked at it on occasion, and I must say to you, Mr. Wiley, that I'm not concerned about it. These people who come in and buy our properties must live by our laws. They are American businesses. They try, where possible, to abide by local customs, and generally tend to do so. And I see nothing but a plus in that, and I think it would be not desirable for us to try to inhibit voluntary access to our markets.
I do respect your judgment. Your bottom line is that you think if foreigners had to disclose it, it might discourage foreign investment, and that wouldn't be desirable at the present time. I had just one more question along the lines of Congressman Heiler's first question. We heard testimony before the Joint Economic Committee by some analysts who argued that the October stock market decline might, in retrospect, have been helpful in slowing domestic demand and thus making available the resources needed to meet expanding export markets without creating inflationary pressures. Now, we don't want to go through another 508-day drop or anything like that, but I take it that it's not something we need to jump out the window about, that our system is basically sound. Would you care to comment as to the testimony which I heard, that it was probably a desirable thing?
Yes, no, I think that's right, Mr. Wiley. I think clearly, while one can never successfully forecast where markets are going, there are two reasons to believe that the markets have taken some of the extreme adjustments out. One, the very fact that the market levels are lower means that a good deal of the speculative pressure is off. But we've also seen a two-thirds decline in program trading, which in my judgment was one of the factors which created the imbalances. And the markets overall are, especially in the Chicago Mercantile Exchange's S&P 500 index, the volumes are down, and we're looking more normal than we have in quite a long while with respect to that. So I think in that respect, we're not teetering on the edge of any secondary problem. Nonetheless, having said that, I think we learned a great deal from that experience, and I think that we have to review what we have learned and evaluate it appropriately for what actions, either by the private exchanges or, if Congress so chooses, legislatively. And that process is well underway, as I see it.
Thank you, Mr. Chairman. You've done very well indeed. We appreciate your testimony this morning.
Thank you.
Neil.
Mr. Chairman. Chairman Greenspan, as you know, I, along with some other members of the Banking Committee, have introduced the Proxmire banking bill over here. The co-sponsors are bipartisan from all regions of the country, and some senior members, junior members, and so on. And I have two questions on that subject for you, if you don't mind. First is, I understand that you support that approach, and secondly, please help clear up something for me. There seems to be some concern on the part of the insurance and real estate industries in particular that anything Congress may do along these lines may not be definitive. And it would be my understanding that should Congress pass legislation in this area that in fact would be very definitive, and we would not expect the regulators, including the Fed and the other regulators, to do anything in the area of granting new powers or anything that would go beyond what the Congress has decided. Please respond.
Well, as far as I'm concerned, Mr. Neal, the Congress sets the laws of the land in this area as elsewhere, and that our job is to implement them as you specify them. And I can't say more than that.
Great. And as to your support of the bill?
Indeed, I do support it, and I've testified on behalf of the bill before the Senate Banking Committee, and have indicated same to many members of this group.
Yes, sir. Mr. Chairman, one of the promises of Reaganomics, one of the early promises was that we would, by following this program, greatly increase the savings rate in this country and therefore productivity. And the result has been the lowest rate of savings that we have ever been able to measure. Could you help me explain, maybe help understand what went wrong?
Well, first of all, Mr. Neal, I think that the forecasts you're referring to were not official forecasts of the Reagan administration.
No, they were claims that
by some
that of well, they were the claim. The basic claims of Reaganomics were that we would make our economy stronger in these very specific ways. I mean, they were the arguments for passing the program.
Sure.
I voted against the program because I did not believe those arguments were true, and in fact argued at the time that we would generate massive deficits and that we would not improve saving and productivity. So,
no, the reason I say what I say, Mr. Neal, is that if you take a look at the official long-term projections early on of the which were the crucial issues of the Reagan economic policy and budget policies, you don't find abnormal increases in savings or in productivity. It is nonetheless true that a number of members of the administration did make those forecasts, and they are factually incorrect. But I would not argue that the general thrust of the President's program necessitated that those particular forecasts prevail. I think a number of things which this administration has done have been quite positive, and a number of the initiatives early on have been very useful. I, too, did not subscribe
savings? In generating savings?
No, in fact, I was about to say that the one area where I disagreed with them is that what they were implementing was either going to significantly increase savings or create abnormal increases in productivity.
One other quick one, if I can. Well, it's not a quick question. I have to say I can make the question quick, but just refer to this chart over here for a minute. And I know you're very familiar with these figures, but you notice the divergence in the long-term relationships between money and economic growth and money and inflation. This one shows the relationship between money and economic growth, and they break down starting in about 1985 and have continued to break down. I know you've spent a lot of time on the subject. What conclusions have you been able to draw now?
The conclusions, I think, which are relevant to this is that, one, it's very clear historically, and if you carried these types of charts back earlier, that money does matter. And it is crucial over the long run to the issue of inflation, and it does affect the economy. My only problem with using it currently and in recent years is that it, in my judgment, for temporary reasons, has disconnected.
No, what are the
from
temporary reasons? What are the temporary reasons?
Well, one, the issue of deregulation, which changed the nature of the types of deposits, the significant alteration in communications, telecommunications, and the whole technology of commercial banking, which changes the means by which individuals have access to the depository system. Those two elements, in and of themselves, in my judgment, have fundamentally changed the particular proxies which we use to try to measure transaction and other forms of balances which move with the economy. The difficulty that we have is not that the underlying concepts are deficient. There are still transaction balances, and those transaction balances do presumably still track the economy. But they are no longer easy to determine, in the sense that a generation ago it was demand deposits and currency, and it was pretty clear. Now what people use as transaction deposits are not only currency, demand deposits, but they use money market mutual funds, they use every different form of instrument to a greater or lesser extent, and it is very difficult for us to capture that as it is evolving. And I think one of the reasons why the changes, the disparities have occurred is that we are still in an evolving stage. I think we will stabilize at some point, and we will find much more stable relationships. But until we do, in our judgment, it would be a mistake to presume that the particular choices we make to measure transaction balances are actually measuring them. The concept of a transaction balance is in the mind of the holder. And we can't measure that directly. We can only do it indirectly, and that's why we have all of these various M1s, M2s, M3s. We haven't captured it correctly in the last 4 or 5 years.
Chairman, talk about in the minds of the holder. The Proxmire bill that Chairman Neal referred to is rather akin to a chameleon. And so I would be reluctant, if I were you, to state an opinion as to whether or not you support it until you see what it is. Because frankly, I don't think anyone knows what it is at this point.
I will be very explicit, Mr. Chairman. I supported the bill as it originally was proposed by Senators Proxmire and Gahn.
And you would await what happens to determine and see what your position will be once the Senate acts.
True, but I go a step further. I do approve and support the process.
Right. Mr. Schumer.
Thank you, Mr. Chairman. Just one point of clarification before I get into my questions, which you may have understood. The Wiley bill, the Wiley-Schumer bill we were dealing with, Mr. Chairman, just dealt with countries that were members of the Warsaw Pact. It arose at a time when the Soviet Union tried, through intermediaries, to purchase a bank in the Silicon Valley that many thought was an attempt to try and get hold of some of the technology plans that were going on there. And I think it had bipartisan support and was not intended, as Congressman Wiley indicated, and I agree with it, to stifle any foreign investment or anything else. My questions, first bunch of questions, are on the crash. You've been widely hailed, and I believe certainly correctly, for providing liquidity on that crucial time between Monday evening and all day Tuesday. First, how much liquidity was actually provided? did it affect the actual provision of the liquidity, the subsequent monetary policy, because one had to make up for how much new money was pumped into the system? Third, what is being done on an ongoing basis if such an occurrence should occur again, so that we might avoid coming near a crisis, as so many thought we have, by the Fed in terms of liquidity?
Well, first, Congressman, what we endeavored to do was to recognize that when we get a shock to the financial system such as that, fear grips everybody, and the consequence of fear is that people pull away, they withdraw, and liquidity is withdrawn from the system. And historically, for example, in the crash of 1907, for example, interest rates jumped very sharply as liquidity was pulled out of the system. We viewed our job as confronting two issues. One, to try to reduce that part of the psychological withdrawal of liquidity which was irrationally based. And we tried, where possible, to communicate to the financial system that some of their views about who was solvent and who was not just made no sense at all. And as a consequence of that, part of the decline in the demand for liquidity occurred without any action of our putting liquidity in. Nonetheless, there was still a very substantial part of rational fear and rational withdrawal, which we had to substitute Fed liquidity for, and we decided that the appropriate amount, since it couldn't be exactly calibrated, would be enough to be somewhat more than clearly was demanded, and that is what in fact we did, and that was measured in part by what would happen to the federal funds rate under those particular conditions. We subsequently found that as the bloated demand began to ease, we were able to withdraw some of those funds. And indeed, we did, although we did it very gradually and I think in a responsible way. However, the changes between then and now have really been quite modest. As I indicated in my prepared testimony, we eased somewhat a while back, several weeks ago, when confronted with growing evidence that the economy was slowing down, and it was possible to do so. But a crucial issue that we still focus upon is that event of last October. We think things are returning very gradually to normal, but I think the term I used in my prepared remarks, there's a sense of edginess still there, and we are very careful to make certain that we are sensitive to what the market needs for liquidity are.
Has the Fed made clear that if another such crisis would occur, that they would step in as quickly as they did in the past?
I think it is implicit in the nature of the system. In other words, as the nation's central bank, that's our purpose. I mean, it's our fundamental purpose in times of illiquidity to supply it. So it's not necessary for us to say we will. That's our job.
Well, given the first part of the problem, as you mentioned, the psychological, it still might, it's like chicken soup. It couldn't hurt, I suppose. I have a second series of questions. I had a second series of questions. With the Chair's indulgence, may I ask one?
Well, let me follow up on this for a moment. Chairman Greenspan, as to, you say you don't have to make it clear, is that perhaps because the Fed, in this instance, in October, having learned from history, what happened in 1929, did not repeat the error, the mistake that was made then, but indeed took the action that was necessary. And so it should be obvious to the public at large, hopefully, that the Fed did learn from its previous mistake that we're not holding you accountable for, because that's 1929. And that in the future, hopefully, whether it be under Chairman Greenspan or one of your successors, they will look at history and say, well, this is the way it should be done, as it was done in October of 1987. That's what we'll do the next time. Is that not a correct evaluation?
Yes, I would think so, Mr. Chairman. I think that the purpose of studying monetary history is to learn how the system works under extraordinary circumstances. And we've had a few episodes in American history which were quite relevant to October the 19th, and fortunately, I think we've learned from them.
Okay. I'm going to go back to Mr. Schumer, but then talking about history and learning, I do want to have a little colloquy with you and see how much we learned from continental Illinois. Now, I don't mean about the options in October, but rather the bailout that occurred a few years ago. And we'll get back to Mr. Schumer, and then I'll come back to you.
Thank you, Mr. Chairman. My next question deals with taxes, saving, and the deficit. On page 17 of your statement, you say, quote, because the United States is now operating at relatively high rates of resource utilization, domestic demand must be restrained if our international sector is to expand without more inflation. What policy alternatives would you recommend if the economy continues along these lines, and I couldn't agree with your policy prescription more, that would restrain domestic demand? Would you advocate, or let's put it in a negative, would you rule out advocating some kind of tax increase, gasoline tax or something like that?
Well, Mr. Schumer, for many years I have been an advocate of an increase in the gasoline tax. And I have been appropriately excoriated by 2 presidents of the United States on this issue. So it's 0-2 at this stage, and I'm getting a little gun-shy.
Okay.
But no, I do think I've always...
Well, let's leave out a gasoline tax. What policy prescription would you recommend for restraining domestic demand so that our international...
I would say domestic demand would fundamentally be restricted in the most appropriate manner by bringing the federal budget deficit down.
And taxes might be a way to do that.
It's one of 2 ways of doing it.
One that you would not argue against, I suppose. Even Mr. Volcker admitted that at one point when I asked him the question. Even. You don't have the cigar, so you're a little more, no smoke rings out there, but second question, related to that, to encourage savings. I mean, obviously we have a limited pool of savings in this country. The federal deficit takes up a good portion of those. There are 2 ways to deal with that problem. One is to have the deficit take up a smaller portion of the existing savings. We've all been trying mightily to do that, and as you note, with some success. What about some kinds of policies to encourage Americans to save, whether it be reductions in some kinds of taxes, perhaps made up for with other kinds of increases so they'd be tax neutral, some kinds of increase in IRAs, etc. What's your view on those? How can we encourage Americans to save more?
You're asking one of the most crucial problems that I think confronts us, and we have clearly been concerned about this issue for a generation. We've had a number of policies, specifically in the tax area and a number of other areas, to try to encourage savings in this country, and the evidence suggests that we've not been all that successful in increasing the aggregate amount of savings. That's what led me a month or 2 ago to suggest that perhaps we're ultimately going to have to find a means of improving the aggregate savings in the system by not only reducing the budget deficit, but perhaps going to a budget surplus, because that would add net savings to the system. It seems to me...
God's ears.
What?
From your mouth to God's ears, as we say in Brooklyn.
What was that again?
From the chairman's mouth to God's ears, that we will have a surplus. He was recommending, Mr. Chairman, we have a budget
something about
surplus.
chicken soup, maybe?
This is like chicken soup, right?
You two fellas having a good time? You born in the same neighborhood?
I don't know. I think it was, may have been the same neighborhood. There may have been a railroad track in between the two. Anyway, what policy prescriptions would you recommend aside from a surplus? Because realistically, we're not going to have a surplus in the deficit for quite a while.
Well, I would say that, granted, we're not likely to have a surplus in the immediate future, but on the way there, we pick up savings. And the most immediate and effective way to add net to American domestic savings is to bring the federal budget deficit down.
So you more or less are not very enthusiastic about methods of actually encouraging the pool of savings.
I would be very enthusiastic if we could be convinced they would work. It's more an issue of being discouraged by having been involved in this game for a number of years and have not been overly successful in finding means which have worked.
Mr. Schumer, you've had an opportunity to exercise, comb your hair, and so forth, but the chairman and I, you know, we've been sitting here, so if it's all right with you, I've got the last couple of questions, and then... Mr. Chairman, going back to Continental Illinois, not the options, but the near failure and then the subsequent bailout, there were strong rumors on the street to the effect that, for instance, the first large withdrawers of jumbo CDs were the Japanese investors or depositors. Now, let's go into a hypothetical here. I don't think we will disagree on the fact that we have a certain number of banks in this country that are fail-safe, as well as perhaps some S&Ls because of their size and because their demise would have such a worldwide impact. Let's say, you know, recall the Hunt brothers when they down there cornered the silver market. Let's say a few nations or one nation or one group got together and decided, hey, well, let's deposit a lot in Bank X, and at a given point in time, we'll pull those jumbos in a very rapid fashion, thereby putting that financial institution in a very precarious position. And then it's up for grabs at a pretty good price. Can you conceive of that happening?
I used to not be able to conceive of a lot of things, but in recent years I can conceive of almost anything.
You know, do we have any, at this point in time, are there any restraints? I know we don't have them legally, or statutorily rather, and I don't think we have them by regulation, but are the regulators in a position where they can now say, learning from experience, say, you know, on the one hand you've got some problem loans, but then on the other hand you're pretty dependent on 2, 3, 4, 5 very major depositors here, who if they were of a mind to, they could just pull the rug out from under you. Is there ever any discussion with some of our banks on this possible problem?
There's a standard procedure of evaluating a bank to try to segregate its so-called core deposits, which essentially are presumed to be fairly stable, and managed liabilities of the type that you suggest. I think that when one looks at it from a regulatory point of view, a supervisory point of view, very clearly, if you're dealing with an institution with long-term illiquid assets and very significant managed liabilities, you've got a disaster awaiting to occur. And as part of the examination process, a number of these evaluations are made, and judgments are made about the safety and soundness of individual institutions. And it's been my impression that supervisors communicate those facts to management and try to hopefully prevent the types of hypothetical problems to which you allude.
Mr. Chairman, I must commend you on your staying power, and but more importantly on your appearance this morning. It's been very valuable to the committee members, and we're most grateful, and we're proud of the fact that we had you before our committee rather than the other side of the Capitol for your first endeavor under Humphrey Hawkins. And we will be sending you some additional questions in writing that you and your very competent staff can enlighten us on enlighten us further with the answers to those questions. So at this time we'll adjourn the meeting, and with our very deep gratitude to you, Mr. Chairman. Thank you.
Thank you very much, Mr. Chairman.